Is it starting to feel like 2007 all over again? That's the question every analyst in the country is trying to answer. The housing bubble that refuses to pop is now approaching a level we have never seen before. Following a surprising run-up in rates, pushing the average 30-year mortgage in the country past 7.4%, many are starting to wonder if this market can make it past the winter. From Austin to Seattle, weak spots are developing, challenging the notion that these absurd prices are the, quote, new normal. The cracks in the system are finally being exposed, and as the pressure mounts, the future comes into focus. Everyone is now concentrated on the how. How will it all go down? Where does the crash start? And to answer that, we look no further than the home builders, which in my opinion have the most reliable opinion out of everyone in the world. They have the most to gain or lose depending on the direction of the market, and listening to their earnings can provide us with valuable insight forecasting what is to come. Last week, America's second largest home builder, Lennar Homes, released their report, answering questions pertaining to the health of the market and what's in store for the future. And as you're about to see, there may be some serious storm clouds moving over the housing landscape. Now, even before this report had come out, it was known that home builders were getting worried. From February of this year to right about now, the average 30-year mortgage rate was increasing. It had gone up from a bottom of 6% to its current rate of around 7.4%. Now, to many, this may not seem like a big move, but it's well understood based on the events of last year that 7 seems to be the magical number for consumers. Once rates pass this invisible threshold, buyers back away and demand dries up relatively quickly. For over a month now, rates have stayed above this level, and there is an already growing body of evidence suggesting that this is having a massive impact on the market. The US NAHB Home Index, which essentially measures homebuilder confidence, saw a high of 56 in July of this year. Since that point, it has been on the decline. The newest reading shows a massive decrease for September, putting the index under 50, which has historically been the point where builders view the environment as poor. Long story short, builders have been feeling the pain throughout the summer, and now as fall approaches, the confidence is eroding even faster. This is further supported by cancellation rates, which as reported by Redfin are quickly increasing. It was noted that 15.7% of all homes that went under contract fell through. This is the highest level since October of 2022, but what does all of this data mean for prices? Is it really evidence that a crash is truly coming? We just had a whole summer where prices continue to go up despite rates at levels we had not seen in decades. If that was the case, then why would it be any different going into the winter? Well, part of the problem is that consumers are finally realizing that rates are probably here to stay, and the possibility of hitting 8% is nearly expected. This is a level that we had not seen since 2000, and with prices where they are today, this level is simply out of reach even for the wealthiest of Americans. What you have to understand is that a typical $300,000 home in 2020 would cost you around $1,500 a month. Today, that same home, even if it's somehow sold for the same price, would cost you around $2,400, and that's at a hypothetical 8% rate. That means even if we don't adjust for the fact that this home is likely much more expensive today, just the sheer difference in rates has made it nearly 63% more expensive to own on a monthly basis. Ultimately, what this comes down to is simply affordability. Americans, even the ones trying to buy today, don't have the necessary income to buy at these levels. It's just not mathematically possible, even if they stretch. Mike Simonson at Altos Research has already reported that inventory is seeing a massive bump up because of these latest rate jumps, and because that magical 7% line has been breached. Inventory is now jumping up in record numbers, reflecting this massive drop in demand. According to Altos numbers, there are now 519,000 single-family homes in the market across the US, which is a 1.9% increase from last week. Considering the time of year, that's a massive increase this late in the season. Specifically, this week we saw a 9,000 unit increase in unsold inventory, which was the single biggest increase week in all of 2023. These stats are an easy way to quantify the fact that buyers are now waving the white flag, signaling enough is enough. Essentially, this winter is setting up to be a bloodbath, especially when you consider the fact that rates are likely not going to get relief. If we look at projections, most analysts agree that because of market uncertainty and inflation, rates will continue to stay elevated for the rest of the year, and as we push towards 8%, the downfall of the market becomes more and more evident. Now, circling back to the home builders, you'll see exactly why everyone seems to be wrong about the market, ignoring the clear warning signs that are flashing red in their faces. As I mentioned earlier, Lennar, the second biggest home builder in the nation, had their earnings report earlier in the week, and based on the commentary from leaders, the direction of the market seems to be obvious. The call started off as most do, strong, positive, relaxed, but dig a bit deeper and you'll reveal a shaky foundation that looks dangerously close to failure. The leadership team at Lennar acknowledged that sales prices have fallen, stating that the net average sales price on home closings has dropped approximately 10 or 11% from the peak of approximately $500,000 in 2022 to approximately $448,000 now. But these comments were followed with some more commentary about consumers ready to accept, quote, higher for longer interest rates and a newfound philosophy of purchasing or renting whatever they can afford. Now, there is some truth that builders have seen some positive numbers in the months past as showcased by their stock price, but now the tide is turning going into the winter. The story from leaders in housing isn't matching up with what consumers are doing on the ground. For example, a Lennar higher-up said the following that showcases exactly what I mean. He claimed that existing housing is kind of a zero-sum game in terms of the supply and demand because every time somebody sells an existing home, they go up and they have to buy another home. So basically, you add inventory and then you subtract inventory, and that's how this specific market is configured, which on the surface makes sense. With nobody selling existing homes and nobody buying, volume levels or the number of transactions actually happening out there are extremely low. This plays in favor of new home builders like Lennar because it creates massive restraints on prices. With such low inventory, home prices for existing homes are very high. In a lot of cases, when you add in the rate incentive and price cuts, it's actually cheaper to buy a brand new home than it is to buy a used old one. This fact has made home builders rich in the past year. Most of their respective stock prices have soared because people will obviously buy new homes in favor of old ones that cost more. It's a logical choice nowadays, but this weird environment may not be around for much longer. You see, while it's true that on the surface the existing home market is kind of a zero-sum game, that game is falling apart due to the fact that investors now make up a giant share of the existing home market. Now, when these people sell, they do not have to go out and buy another home. This is especially the case if they are losing money on it. The whole zero-sum theory goes out the door when you consider this fact. And it's here where the trouble is. When investors bail, who will buy the inventory? The demand is simply not there. This cascading effect of investors dragging down the market like a weight will eventually ripple through the new home market, starting a vicious cycle of price cuts. New builders competing with the imploding existing market will create an effect similar to the '08 crash, where one component of the market, the investors, kickstarts a loop of doom, pushing prices down in an uncontrolled spiral. Thank you guys for watching. As always, please make sure you hit that like and subscribe button if you enjoyed it, and don't forget to drop a comment below letting me know what you're seeing in your local market.